Hey everyone, Supermicro reported third quarter 2024 financial results that sent the stock price down nearly 20% after those results were announced. Of course, coming into the quarter, I told investors not to buy Supermicro stock, not to buy it. In fact, I told investors to take profits on Supermicro on March 6th near the peak valuation. So I'll go through these latest earnings results and I'll update my recommendation of Supermicro stock and let you know if it's a buy on this dip here.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Alright, so Supermicro reporting continued acceleration in revenue growth here. 3.85 billion in sales versus 3.66 billion in the previous quarter and 1.28 billion in the same quarter the prior year. So sales nearly tripled from the same quarter last year. Gross profit margin, however, declined to 15.5%, down from 17.6% in the same quarter last year. And this starts the story on why I recommended investors take profits in Supermicro stock. In this video I made on March 6th, I said investors should take profits in Supermicro stock. I had recommended Supermicro stock as a buy around January. And then on March 6th, I said, okay, enough is enough. The stock price has increased so much, more so than the increase in the fundamental performance. I suggested it was a good time to take profits. At that time on March 6th, the stock price was at $1,124 per share, and that was near the peak. Its highest valuation was $1,188 per share. So I told investors to take profits near the peak. It's now trading at $725 per share. So if you sold when I recommended a sell, you would have saved $400 on this stock here. Now, to continue with the earnings results, diluted income per share of $6.56 was up from $1.53 in the same quarter last year. That's great news as well. Profit expanding by nearly 4x year over year. Now comes the troubling part of Supermicro's business. And that is starting with cash flow from operations, which in the third quarter was negative 1.5 billion, negative 1.5 billion in cash flow. That's troubling. Now, this isn't rare for companies that are experiencing this level of growth because they need to invest in the inventory, create the inventory first before they can sell it and collect the cash. But this level of negative cash flow from operations, and this is now the second straight quarter of negative cash flow from operations, is a little bit troubling for investors. It's a little bit risky for investors to have this much tied in negative cash flow from operations, especially when you consider management's strategy here. They're looking for growth. They're seeking growth. They're offering their buyers, their clients, introductory terms so that they can get in and then expand. Management has often discussed they want to employ the land and expand strategy. They want to get in with these businesses. They'll offer them a good deal to begin with, and then they want to expand within the business. They want to get in and expand. That's the strategy, and that strategy is often expensive in terms of promotions, incentives. You might need to offer better accounts receivable terms. Instead of telling them you have to pay us back in 2 weeks or in 30 days, you tell them you can pay us back in 90 days or 120 days. And that will make your clients more interested in buying your products if you give them more time to pay you back. But that's also risky because Supermicro doesn't have that strong of a balance sheet to offer this kind of support. And I'll go over its balance sheet a little bit later in the video. So management saying that they had yet another record quarter with revenue of 3.85 billion and non-GAAP EPS of $6.65. That's year-over-year revenue growth of over 200% and profit growth of over 300%, well over our industry peers. And yes, growth has been phenomenal for Supermicro. That's why the stock price absolutely exploded to begin the year, and it's now retracing some of that increase. Because of this growth, they're raising their fiscal year revenue outlook to from 14.5 billion at the midpoint up to 14.9 billion at the midpoint. So they now expect 400 million more in revenue in 2024 than they previously did. And this was yet another upgrade in their annual target. I've lost count. I think this is the third increase in their 2024 revenue outlook. They keep raising expectations higher because results, at least for sales, keep coming in better than they initially thought. So I highlighted that I would discuss their balance sheet, and let's get into the details here. So on March 31st, 2024, they now have $2.115 billion in cash and equivalents. That was up from $440 million in June 30th of 2023. But also they increased their inventories to $4.124 billion, up from $1.445 billion in June 30th, 2023. So their total current assets jumped from $3.179 billion up to $8 billion. Right, their total assets jumped by almost tripled, more than 2x. And when you increase your total assets, investors want a greater return on those assets. So by increasing your assets, you're also increasing the profitability that investors require from your business, because you're now employing greater amounts of assets. Just like if you ran a restaurant, you had one location, you add two more locations, now investors are expecting 3 times the profit because you went from one location to 3 locations. And if you increase your profits but not by 3x, that doesn't look as impressive because you added 2 more locations. You had more assets under management, so you are expected to deliver more profits to investors. Now, I mentioned that their balance sheet wasn't so strong, so they needed to go to investors and get more money. That's how they increased their assets, because they went to investors and got more money from investors. They sold shares of stock and they offered a convertible note. You can see here they added $1.7 billion in convertible notes. That wasn't there at the point last year, June 30th. That was non-existent. And then they sold more stock, which is in the form of paid-in capital, and that comes in at 2.8 billion now, up from 538 million. So 2.3 billion added there, and then 1.7 billion added from convertible notes, and that roughly reaches that increase in total current assets. So the company had to go to investors to get more money, and that's not always a great thing. Investors look at that as risky, and they require a greater rate of return now that you have more assets under your balance sheet. So I'll review the financial statement here, the cash flow statement, I should say. And you can see the net cash used in operating activities was negative 1.8 billion in the 9 months that ended March 31st. That's compared to 672 million positive in the 9 months ended in 2023. And they used 131 million in investing activities. These are capital expenditures. And then they got all that money from financing. They raised the money from the convertible note issuance and selling stock, and that was 3.652 billion. This is kind of the opposite of what you want to see when you're investing in a company. Think of your own personal balance sheet. You have your assets like your home and your car and maybe your computers. You have your ability for financing, meaning your credit cards, right? You can go out and borrow money. And then you have your operating activities, which is if you have a business, that's your business. If you work for a living, those are your wages. Out of those 3 sources of raising money, your most favorite source, the best source for raising money, is through your services or through your business, earning that income. The least favorite is from your credit cards or borrowing the money, right? That's the least attractive source of generating cash. And then finally, investing. Of course, you can sell your house and raise cash, or you could sell your car and sell your computers to get cash, but that's unsustainable too. So the primary source, the area where you want to see the most cash flow coming in, is from your operations, personally, and in your business. And Supermicro is doing the opposite. It's getting cash from financing activities, borrowing and selling percentage in the business, and it's going negative in the operating activities. Not what you'd like to see. However, I will acknowledge that this is likely short term as it's building up inventory, growing into capitalize on this massive artificial intelligence opportunity. But they're doing so in a more risky way than, let's say, Nvidia, which is not only are they growing rapidly, similar in rate of growth as Supermicro, but they're also doing so very profitably and generating strong cash flow from operations. So that's a bit of a difference here, and that's why investors are a little bit hesitant with Supermicro. The company's never been very profitable to begin with. They don't operate with large profit margins. And so this growth explosion with these negative cash flows and limited profitability is spooking a few investors, and understandably so. So after the stock price decrease, it's now trading at a forward price to earnings of 24. And I've said valuation is one of my concerns with Supermicro. That's why I acknowledged investors that it's a good time to take profits. And even at this valuation at 24, you can see how it's more than twice what it used to trade for at 12 and below. So I still don't feel comfortable with Supermicro Computer at this valuation, even after the sell-off. So I'm keeping the stock rated as not a buy or just a hold and market perform for now. I wouldn't be surprised if I upgrade this stock later as it right sizes the business and it gets into a better flow between investments in growth and growth that delivers cash flow and growth that delivers more profit. But for now, given the valuation and given the position of the balance sheet and the cash flow, I'm not comfortable recommending it as a buy at this point. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.